Hi, I'm Bo Evans from Bo Evans Realty. Today, I'm going to talk about something that's going on in our market and when you really need to discuss it, and that's rising interest rates and what impact it has on home sales. And so our friends at Keeping Current Matters have put together some information for us so we would know. And I wanted to share that. If you have real estate questions, please call one of our team members at Bo Evans Realty. Our number is 334-361-4661. We're happy to help you anytime. We can help you get through this maze of strange things that are going on in our market. So let's take a look, first of all, what's going on with interest rates. As you can see here, in December of this year, interest rates were at 3.11%. Now, that is incredibly low. That's historically low. I can remember when rates were in double digits. I'm sure a lot of people out there can. A lot of people in real estate can remember that. I remember distinctly the day that rates went to single digits. At the end of March, rates were at 3.31%. Now today, they stand at around 5.25. So they have gone up. Remember this, that a 1% increase in interest rates, increase or decrease, affects buying power by $10,000 to $20,000, depending on the price range you're in. Now, Lynn Kiefer from Freddie Mac says this, that mortgage rates will continue to move higher throughout the balance of 2022. He believes they're going to keep going up. So do I. Although the pace of the rate increase is likely to moderate. It's going to get slower. We're not going to see these huge increases in a short amount of time. Although much of the increase in rates in early 2022 is in anticipation of what will happen later this year, especially with Federal Reserve interest rate policy. Now, what the Fed is trying to do is they're trying to get a hedge on inflation. You may have read that inflation is climbing at a rapid rate. Or the last consumer price index was an increase of about 8% from the same period last year. That's incredibly high. So the Fed will have to adjust interest rates, the money that they charge banks, in order to put a hedge on that inflation. The higher it costs banks, the more they have to charge to loan people money, which means that the money that's out there available is smaller, which actually will lower inflation over time. At least in theory, that's what happens, and it's happened many, many times. Now, let's look at what the effect on home prices is when rates go up by more than 1%. And you'll see here that home prices typically will go up. Okay, if you look at October 1993 to December 1994, that 14-month period when rates went up the most of anything on this chart, 2.38%, home prices went up by 3%, which is above inflation. That is a pretty healthy standard rate of appreciation. That's about what Prattville, Millbrook, Montgomery, what the river region has gone up, has increased over the last 20 years, 22 years, since the year 2000 on average. It's about what it's done the last 30 years that I've been in business, just 3% a year. There's been higher and lower, but that's an average. And if you look at June 2003 to June 2004, that 12-month period, rates went up by 1.06%. Home prices went up by 13%. Now, that was driven by some other things too, which we'll get into later when we look at sales activity and that sort of thing. In that June 2005 to 2006, in the middle of the recession, in the middle of the crash, home prices actually went up by 7%. And the last time we had November 2012 to December 2013, that 13-month period when rates went up by 1.11%, home prices went up by 11%. So if you're a homeowner or a seller, you're in good shape. You're not going to lose value just because interest rates went up. Now, if we look at the impact on home sales, okay, for that highest period, that 93 to 94 period, when the increase was 2.38%, home sales went down by 11%. It's a pretty tough time in real estate. It's a pretty tough time when you needed to sell a house. Now, if we went down that much, if demand went down that much, we would probably be about where we normally are, just to be perfectly honest with you. But if you look at all these other time periods, with the exception of that 2005, 2006 time frame, home sales were relatively flat. In 2005, that 13-month period to 2006, when rates went up by 1.18%, home prices went up by 7%, we lost 14, sales went down by 14%. Now, that was affected by a lot of other things. That was the middle of a recession. That was when the housing crash, the financial crash happened. Things got really, really bad. That was the middle of it. That was the beginning of the end. So that's why home prices went down. We had demand, a lot of speculation, and things just went down quickly. Now, if we look at the increase in rates and what happened here, what the final rate was in 1994, December 1994, the final rate, the highest interest rate we got was 9.2%. Okay, now we're not talking anywhere close to that, folks. We're talking about 6, maybe 6.5. None of these are that low if you look at that, except for that November 2012 to December 2013 period. Home prices stayed steady. They went up most of this time. Home sales were relatively flat, except for the 2 time periods that we talked about before. In fact, they only went down by about 5% in that time. We had a 5% decrease in home sales. We would be about normal where we normally would be. Now, again, if we look at how many months it took this, what those final rates were over this period of time, and we take out that 93 to 9, that earliest time period, and we take out and we look at that 8-month period beginning in 96, which is about 25 years, we see that we've only lost 4% in value. So, you know, that was an effect for that period, but not that big of an impact, right? Now, let's look at inventory. Inventory is very important if you're trying to sell a house. It's very important if you're a real estate agent, because that gives you an idea of what the market's doing and how long it's taking us to absorb what's out there. And we don't have that much information for that 96 and 98 time period. However, we do have information for June 03 to 04, June and July of 05 and 06, and that November to December 12 and 13 period. And if you look here, the inventory, the months of inventory average was 4.8 months. Now, theoretically, what that means is if nothing else went on the market, it would take 4.8 months for the entire market, for the market to absorb what's on the market at that point in time. That is still a seller's market. Okay, so if you have a house to sell, you'll still be able to do it. Okay, it's not until we get to that 6-month time frame that it's a balanced market. So we're getting pretty close to a balanced market, but we're not there. Now, if you look at what some of the experts are saying, Nadia Evangelo, who's from NAR, she's the director of forecasting. She says, while higher short-term interest rates will push mortgage rates, I expect some of this impact to be mitigated eventually through lower inflation. So we can expect lower inflation because they're doing this. This works. The Fed has done this many times, and it seems to. Now, we can argue whether they're too late or too early or whatever. That's certainly arguable. Economists would argue about that. It might make an interesting conversation, but we're not here to discuss that. She expects the 30-year fixed mortgage rate to continue to rise, although they aren't likely to see the big jumps that have occurred in the past few weeks. Again, she expects us to kind of mitigate over time and be less quick, less brisk. Freddie Mac says that history suggests that when rates rise, there's an initial bump in home prices as many move quickly to buy a house before rates increase further. But after that period, home prices slow. Freddie Mac analyst shows that a 1% increase in mortgage rates results in home prices appreciation that's 4 percentage points lower. For instance, a 1% increase in mortgage rates would change home prices growth from 11% to 7%. Now, in the last quarter of 2021, we had an 11% increase in home values appreciation. So we don't know what it's going to be this month. We don't know what it's going to be for the year, but I expect it's going to be that or higher. So coming down 1%, 4% for every 1%, well, you'll still make money in your house. You'll go from 11% increase to a 7% increase. Yeah. Now, will it keep up with inflation? Well, we hope so. That's why we're lowering rates. With rates rising, expected to rise throughout through 2023, it makes sense to obtain a purchase or refinance mortgage if you're in good standing. Now, it's okay. I promise you, folks. One of the things that happens is lenders do tend to come out with new programs that help with these interest rate increases. There tend to be some kind of creative things that they do when they get really high. We're not even talking about that. I mean, some people are expecting credit card rates on mortgages. That's not going to happen. We're not going to have a crash. None of that's going to happen. We're having a simple increase in mortgage rates. We'll still sell houses. If you have a house to sell, it will still sell. If you're looking to buy something, you'll still be able to find a house in your price range. So, just be patient and, get out there. If you have questions, if you're looking to buy or sell and you have questions, please feel free to call one of our team members, 334-361-4661. We are happy to help you get through this maze of things that are occurring out there. There's so many things. It's an interesting time in real estate, and we want to help you get through it. In the meantime, have a great day. We'll see you later. Thank you and goodbye.